So we just have had this instance where the Hong Kong exchange tried to buy the London exchange. You took a look at New York Stock Exchange, at London Exchange, things like that at various times. Is that inevitable to have those sorts of consolidations continue right now among the exchanges internationally?
Yeah, so it's described in the book. We made two approaches to the London Stock Exchange. Neither of them worked out. It was there to be consummated, but the price wasn't the right price for us at the time. So what you have to understand with exchanges, we are, and one of the reasons I got hired, they're technology companies, we're transaction processing companies. And what that means is an incremental trade doesn't really cost any money. So Nasdaq has enough processing power, or they did when I was there, to run every equity trade on the planet, on the existing hardware they have. So great scale economics if you do that. So that's going to be always a driver, right? Now, what mitigates that driver is the fact that you have regulatory bodies, legislative bodies that may or may not like that deal happening. So Hong Kong, that was a quick round trip in and out. So I don't know all the details of what transpired behind the scenes, but probably it was, related to other issues beyond the economics.
We're talking with Bob Greifeld, former chairman, CEO of Nasdaq. So Bob, right now there's a big dispute, contest, discussion going on about IPOs, which were terribly important to you at Nasdaq, as opposed to direct listings. But Nasdaq, as I understand it, sort of had both experiences. Didn't you start out with a direct listing before you got there?
We did it when I was there, actually.
Oh, when you were there?
Yeah, we were...
so what's the pluses and minuses of direct listing versus IPO?
Well, I think the direct listing will have a niche. It's not going to go away, but it's not going to take over the market, right? So if you have zero need for capital, you have a brand in the investment community, then direct listing comes into frame and you have to make your decision. The advantage of the direct listing then is you don't have to get involved with what is the right price, right? So if I'm a company, I come public, the stock is up 40% or down 40%, I'm the CEO of the board. I don't really want to be in that game of trying to decide how to play that. I'd rather just get the right price. So if you list first and then raise capital a year later, right, then you'll know the price because the stock is trading. So that's, an attractive alternative to some, but not to many, I would say.
But if you look at tech, which certainly you specialize in at Nasdaq, we've had several of these IPOs go on, and certainly the investment bankers or the management didn't find the right price.
That's happened.
They've been very disappointing in the last few weeks.
I would say. I would also say this, though, that the public markets will discover the right price with a lot higher frequency than the private market. So when you look at the source of some of this issue, you had, I think, abnormal price discovery happening in the private market. The private market is primarily a bilateral deal between you and I, right? We could get it wrong. Right, public market, you have all to all, a lot of people in it, and the odds of getting the price right are significantly higher.
So finally, spend 1 minute on China, because there's a lot of talk right now about sort of curtailing investment from the United States into Chinese companies and China in the United States, not just in the White House, but also up on Capitol Hill, because they don't have the same accounting standards, they don't have the same auditing standards. What would that do as a practical matter to capital markets if we curtailed that flow?
So first, I would say, in the context of the trade discussions, there's a lot of posturing going on. There's a lot of smoke being raised. So I wouldn't pay too much attention until we see what the final deal would happen. I would say the Chinese companies have a great desire to list in the U.S. because we are the deepest, most liquid capital markets by far and away the most efficient. So that's going to be a driving force to make that happen. But with respect to the disclosure and the accounting, our investors, right, under the SEC regulation, expect a high standard, and certainly Chinese companies have to conform to something that's, equivalent, whether that be our standards or IFRS or something like that. You're going to need to see that, right? So I think we have something, that is a good framework that we should continue with.